The largest financial market in the world is not stocks. It is not bonds. It is not real estate. It is derivatives. Depending on how it is measured, the global derivatives market has a notional value exceeding hundreds of trillions of dollars. Some estimates place it above 600 trillion. These contracts rarely appear in public discussions about finance, yet they shape how banks manage risk, how corporations hedge exposure, and how investors speculate on future prices. Derivatives are agreements whose value is derived from something else: an interest rate, a currency, a commodity, or an asset. In theory, they exist to reduce risk. In practice, they can also concentrate it. This is the story of derivatives: how a market designed to manage uncertainty became one of the largest and most complex systems in modern finance. A derivative is a financial contract whose value depends on the price of another asset. That underlying asset could be a stock, a bond, a commodity, a currency, or an interest rate. Common examples include futures, options, and swaps. These contracts allow participants to transfer risk. A company exposed to rising fuel prices may use derivatives to hedge costs. A bank exposed to changing interest rates may enter into swap agreements to stabilize cash flows. Derivatives are traded both on exchanges and privately between institutions in over-the-counter markets. The system grew alongside global finance. As markets expanded and financial exposures became more complex, derivatives provided tools for managing those exposures. However, their complexity also increased. Contracts can link institutions across continents and involve obligations extending years into the future. While derivatives are essential tools for risk management, their scale means they connect financial institutions in ways that are not always visible. Derivatives promised efficiency and protection. They allow risks to be transferred from those who cannot bear them to those willing to take them. Airlines hedge fuel costs, exporters hedge currency fluctuations, investors hedge market volatility. In this sense, derivatives act as financial insurance. The promise is stability. By redistributing risk across markets and institutions, derivatives are meant to reduce the impact of unexpected events. If oil prices rise, an airline's hedge can offset higher fuel costs. If interest rates change, a swap agreement can stabilize borrowing expenses. This ability to separate risk from the underlying asset allows markets to function more smoothly. Derivatives also increase liquidity by enabling participants to take positions without directly buying or selling the underlying asset. In theory, they make financial systems more flexible and resilient, but flexibility can also create complexity. The derivatives market expanded rapidly during the late 20th century as financial globalization accelerated. Interest rate swaps became common tools for banks and corporations managing debt exposure. Currency derivatives helped multinational companies navigate volatile exchange rates. Investment banks played a central role in structuring these contracts. Over time, derivatives evolved beyond simple hedging instruments. Investors began using them for speculation and leverage. Because derivatives often require only a small amount of capital relative to the underlying exposure, they allow participants to take large positions with limited upfront investment. This leverage increased both opportunity and risk. The market grew enormous. Interest rate derivatives alone account for the majority of the market's notional value. These contracts allow institutions to exchange fixed and floating interest payments over long periods. Derivatives became embedded in nearly every part of modern finance, from mortgage markets to corporate bonds to commodity trading. The system appeared efficient because it allowed risk to be distributed across many participants. But distribution does not eliminate risk. It redistributes it. Derivatives become dangerous when complexity obscures exposure. Because contracts are interconnected, the failure of one institution can affect many others. This risk became visible during the global financial crisis. Large banks had written vast amounts of credit default swaps, derivatives that acted like insurance on debt securities. When mortgage-backed securities began to fail, institutions that had sold this protection faced enormous obligations. The collapse of AIG illustrated the danger. The company had written hundreds of billions of dollars in credit default swaps tied to mortgage securities. When the underlying assets deteriorated, AIG could not meet collateral requirements. Governments intervened to prevent cascading losses throughout the financial system. Derivatives did not cause the housing crisis, but they amplified its impact by linking institutions through complex obligations. The challenge is that derivative exposures are not always visible in balance sheets. A contract may appear small relative to the underlying exposure it references. Furthermore, many derivatives require collateral to be posted as market prices change. If asset prices move quickly, institutions may face sudden margin calls. These calls force participants to post additional collateral or unwind positions rapidly. In stressed markets, this can accelerate price movements and create liquidity pressure. The derivative system is therefore sensitive to volatility and confidence. It works smoothly when markets are stable and counterparties trust one another. Under stress, the same connections that distribute risk can transmit it rapidly. A severe derivatives collapse would likely emerge through counterparty failure. If a large institution cannot meet its obligations, the impact spreads through contracts linked to other participants. Collateral requirements rise, positions are closed, prices move sharply. Central clearinghouses now mitigate some of this risk by acting as intermediaries in many derivatives trades. However, large portions of the market remain bilateral agreements between institutions. The collapse would not necessarily appear as a single dramatic event. Instead, it would unfold through cascading liquidity stress as participants attempt to manage exposures simultaneously. Following the financial crisis, regulators introduced reforms to improve transparency and reduce systemic risk. Central clearing requirements increased, reporting standards expanded, capital requirements for derivative exposures were strengthened. These measures improved resilience but did not eliminate complexity. The derivatives market remains enormous because it fulfills a fundamental role in modern finance: transferring risk. As long as markets contain uncertainty, institutions will seek tools to manage it. Derivatives remain one of those tools. Derivatives reveal both the sophistication and fragility of modern financial systems. They allow risk to be hedged, transferred, and priced in ways that make global markets possible. At the same time, their complexity creates networks of obligation that are difficult to map completely. When markets are stable, derivatives appear invisible. When markets are stressed, their connections become visible all at once. The derivative system is not inherently unstable, but its scale means that when something goes wrong, the effects can travel far beyond the original event. Understanding derivatives is therefore not about speculation. It is about understanding how modern finance connects risk.